Let's do all of that with StoneX Chief Market Strategist, Kathryn Rooney Vera. So Kathryn, talk to me, because I think for a long time, you had a government that was spend, 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 and the economy was flourishing because you're just hiring anyone and putting money out into the ether. But eventually we have to pay the piper. And I'm getting worried now that the debt problem is becoming so much of an issue that we're cradling under that and we can't grow our way out of it. How do you see this?
Well, you nailed it, Taylor, and I'll add to your points, which are absolutely correct, which is that interest payments now exceed the expenditures that we have on defense. And so interest payments as a percentage of GDP have doubled over the past 2 years. That's a very pernicious cycle. It's not a good scenario where you have an economy that's slowing down in terms of economic growth, still pretty strong, and that's the good news. Productivity is still high, but you have a phenomenon called the crowding out of the private sector, and that to me is not talked about enough.
Can we talk about it then? When you think about this crowding out effect, one thing that worries me is the more that we do on interest payments or non-discretionary, the less there is room to cut then in the discretionary. And then you have comments from Elon Musk saying maybe we'll do $1 trillion instead of $2 trillion cuts. How does that change the way that you think about investing in the markets, about future economic growth in this crowding out effect?
It makes it so hard to do those deficit, not just deficit, but spending reductions, because tax cuts are phenomenal, and we're going to get a corporate tax cut, but that takes some money out of the coffers in a time where we have 6.5% deficit to GDP, which is pretty egregious. So it does make Elon and Vivek's job much more difficult. And it's disappointing to hear that we're already hoping for $1 trillion instead of $2 trillion, especially because tax cuts would be a great thing, but we can't continue to blow out the fiscal deficit. The reason being because you have to finance your deficit with bonds. And the public market, the government, is competing for the same pool of the capital markets that the private market is. And so what happens? You have a rising deficit, higher debt, and that increases interest costs. And that starts to affect not just you and me, but corporations, investment in their own businesses. Everything becomes more expensive. So it's harder to invest these companies in themselves and in infrastructure.
So on that note, you are an investor. You're a market strategist. You're advising people where to put money and where not to. A 10-year yield at a 4.6. I was talking earlier today, you have a 30-year that almost hit that key 5% level. Is that an attractive area in which to put your money? Or do you think if yields continue to go higher, that means bond price goes lower? You don't want to be in that.
I don't want to be in the long end of the Treasury yield curve. I think it's going to continue to move higher because I don't see a real end to the story that's positive. I think we're probably going to stick with big fiscal deficits. So what does that tell us? That tells us bond yields stay high, probably move higher. I think the 10-year tops 5%. There is a price for everything, but the problem therein is that it starts to negatively affect the equity markets because you can get a better return on a Treasury than on a riskier asset, which is equities.
So let's talk about the equity markets, because you and I were laughing on set that and the math is simple, and I think it's good for our audience to know this. There's a classic discount cash flow model. All that says is you plug in a 10-year Treasury. The higher that number is, the math says, the lower the equity value on a present value basis is worth. So when yields go up, the market in theory says your equity is worth less. Is that where we're going? Does this rise in yields really start to pressure your equity markets?
Thank you, Taylor Riggs, CFA. The CFA is a wonderful thing. No, but you nailed it, and that's the way it works. I think that we're probably going to see corporate profits come under some pressure because of higher financing costs, because the Fed probably can't even cut as much as the market's expecting, inflation, financing costs, and potential tariffs. So I think when we're looking at the equity markets and we're coming into earnings season, we need to be looking at asset or sectors in the S&P that do well under a high interest rate environment, because I doubt the Fed can cut very much from here.
Is that big tech, or is that something else?
That's not big tech. So I think we need to buy protected puts on big tech in the event that, because tech doesn't do well in higher interest rates environments. I would be recommending real estate and utilities. And then for a strong economy that I think we're still in and we're going to remain in, I even think we could be overheating here. I like energy and industrials. So those, and banks. I also like banks. I think under a Trump administration, they do well.
Well, we love having you on because you give us something besides just Mag 7 to talk about, right? Real estate, utilities. They call it boring, but it's interesting when it makes you money.
This year, it made a lot of money. Utilities was up 30%.
Kathryn Rooney Vera, thank you so much.
My pleasure.
We appreciate it.